Hey folks, it's Simon here with your Tao Daily for Wednesday, the 18th of September 2024. Today is Fed Day with another very highly anticipated FOMC meeting. Will they cut by 25 or 50? Nobody really seems to have a clue. Now, the common question I get is, are rate cuts good for the stock market? And the answer is, it depends. All right, it depends on why the Fed is cutting rates. Is the Fed cutting rates just because rates got a little tight and they just need to do a bit of an adjustment, bit of a normalization? Or is the Fed cutting rates because they don't like the economic data that's coming through and they're worried about a recession? Now, if it's the former, that's your soft landing scenario. Okay, if things are a bit tight, we'll just loosen things up a bit, go about our business, the economy will still keep humming along. That's your soft landing. If, however, the Fed is looking at the rapid rise in unemployment and a host of other economic data that are showing a deterioration year on year, they may start things with a 50 basis point cut because they're concerned about the fact that the economy may be heading into a recession. Now, if we do enter a recession, it's going to be bad for stocks. So it doesn't really matter what the Fed's doing. All right, we've seen this movie play out before. We had a cutting cycle in 2007, 2008. We had a cutting cycle in 2000. Both of those were accompanied by significant drawdowns in the stock markets. Now, if we look at two-year yields, they've gone from 5% in May down to 3.59% today. All right, this is a significant move down in yields, and it's important because two-year yields typically lead the Fed funds rate by approximately 6 months. Now, if we look at the spread between two-year yields minus the Fed funds rate, which currently sits at the effective rate's around 5.35%, that spread is deeply negative. It's nearly minus 1.75%. And we saw this spread reach deeply negative levels just before the global financial crisis, just before the tech wreck, around the time of the LTCM collapse, and around the time of the savings and loan crisis. Okay, the point being that the market here is forecasting an aggressive cutting cycle. Okay, a cutting cycle that is probably not consistent with just a normalization in rates. It looks a lot more like a cutting cycle that would be consistent with some sort of a fairly major decline in the economy. So Fed rate cuts, it could be a short-term positive. If we do get a 50 basis point cut today, the S&P may well pop to a new all-time high. It did try to do that intraday, didn't manage to stick the gains. But if it becomes apparent that the US economy is sliding into a recession, any pop short-term on rate cuts would end up being a massive rug pull. That's what I got for you today. I hope it helps, and we'll chat about what the Fed actually did tomorrow. Thank you.